They are sceptical about it. And I think the scepticism comes from a number of quarters. One is the highly successful trader who's traded on sentiment or instinct, gut instinct, who thinks I've made plenty of money, no need to learn another way of analysing the market. Quite right too. Another quarter of criticism, or another area from where you get criticism, is the fundamentalist, who thinks this is a better way to run to understand the markets, and sure enough, if they're good at it and make money, then why on earth should they try anything else? There's another sort of a quarter from which there's criticism, and that's the person who's looked at it and not given the time required to be successful using it. They think it is smoke and mirrors nonsense. I think the biggest criticism comes from the person that has had a fleeting or superficial acquaintanceship with charting and hasn't mastered it, and finds it lets them down, and therefore they understandably turn on it and think the thing doesn't work. Whereas, like anything worthwhile and successful, you've got to put a lot of effort into it. It is not, and you mustn't imagine it's something that it isn't. And the sort of imaginings that it's something that it isn't fall into different sorts of things, like that it is a mechanistic way. There are rules to follow whereby you're going to make money. There are no rules. There are rules of construction of charts, but the judgment required is enormous to consistently make money from them. Expecting too much of charts is that you should make money with every pattern, for example, or every trade, is nonsense. What charts do is they throw the odds in your favour if you're trading in line with a trend or a pattern. They get you into the market, get you out of the market, and if you consistently use them over time, you will tend to make money. The odds will be thrown in your favour. But they are not a mechanistic rule for squeezing money from the market. The whole question of combining fundamental and technical analysis is a fascinating one. It's not an easy marriage. The rationale is this, that if you can get a technical picture that favours a trade, and you find a fundamental picture at the same time that favours a trade, then the trade looks extra good. The issues of trading are getting into the market and then controlling your position. The fundamentalist tends to have a longer term view. He wants to wait till the fundamentals turn before he gets out. The technician tends to look to be rather shorter term. So even though they may work together in tandem to get you into the market, getting you out of the market may be problematic. They can work. It has to be worked out very hard, and it isn't an easy one. But obviously, I think if you can do it well, two brains are better than one.